And most astonishingly of all, if you look at a GDX, which is the largest fund for gold miners, senior gold miners, again, even now, with the gold stocks having moved up so much, you go back to April the 8th, and there have only been 2 days where Vanguard, the fund sponsor, has reported net inflows. I mean, it's just astonishing.
Welcome to Capital Cosm, everybody. Today we've got the one and only Adrian Day on the show. Before we get started, be sure to hit the subscribe button, like this video, help support the channel in whichever way you can. If you want to give a monetary donation, my Buy Me a Coffee link is down below. So, all right, Adrian Day, thank you so much for coming on, my friend.
Well, thank you very much, Danny, for asking me.
Excellent. Well, hey, Adrian, for people who may not know who you are, give us a little bit of a background into your investment journeys. Who are you, and what kind of got you into this investment field? Gold, silver, commodities, all of that stuff.
You mean there's someone out there that doesn't know who I am?
There might be one or two that have just been living under a rock.
Yeah. So I'm from England, as you can probably tell. My background, my college, I actually studied history. Very interested in history, very interested. I went to London School of Economics, so a lot of economic history. And 19th century was my specialty, or my area of interest. And so the gold standard became a topic that I studied. In fact, my very first investment, that was before I went to college, my very first investment when I was a boy in short pants was to go and buy a gold Britannia coin. But anyway, so the interest came through, I guess the interest came through history, came through seeing the value of gold, throughout history. And, that took me into investing in it. At first, I was a writer on economic policy for a conservative organization in England. So I used to write on economic policy, but, that sort of takes you into investments, I guess. And then in 1991, I started my money management firm, frankly, because I just had a lot of requests to do it from people who read my writings. And said, I always seem to miss out on your buys, and I'm on holiday when you say to sell. So can you do it for me? So I've been managing money for clients since 1991 with my own firm, and then we manage Peter Schiff's gold fund and gold individual accounts. And I've been doing that since 2013.
Well, I find it particularly interesting, your background in history in the, the 19th century, you said?
Yeah. I wasn't in the 19th century, but yeah. Well, I did British history, and it was a sort of overview of all of British history from, Romans through to today, which is a topic I'm just fascinated with. And my specialty was on British imperial history, which I also find fascinating. But yeah, one of the things I find, I don't know, I interrupted you, I'm sorry, but one of the things I find is people, and I'm not talking about me now, but people who come from different disciplines, and particularly disciplines that deal with human nature. So it might be psychology, it might be English literature, not at a modern day liberal East Coast university, of course, but who study English literature, or any literature for that matter, sorry, if you're not from, the English speaking world, and then history. These disciplines tell you about human nature. And studying human nature is just incredibly valuable when you're investing.
Yeah, it's paramount.
Yeah, and I find that a lot of the people that do the traditional route and get MBAs, everything is too mathematical. That's not to say they can't succeed, but it's all very, very mathematical. Whereas I think a large part of the market is, the dynamic of, human psychology, the dynamic of how crowds think and how crowds react. And you know, you get that from history, you get that from literature, you get that from psychology. Some of the best, not me, but some of the best investors, if you think of the last 50 years, have in fact been people who.
Hey, Adrian, sorry, you cut off for like 10 seconds.
Um,
You were just saying some of the best investors were, and then you cut
yeah,
off.
some of the best investors over the last 50 years have been people who didn't come from MBAs, but came from these other disciplines.
Yeah, because I mean, essentially, you can distill the markets to fear and greed cycles. You know, we go.
Exactly, absolutely, absolutely. Especially if you're a longer term fundamental investor, as I am, then it's obviously if you're a momentum investor or you're doing, you know, using algorithms to time the market on a minute by minute basis, obviously human psychology doesn't play into that. But if you're a longer term fundamental investor, it's very important.
Well, yeah, I mean, that's where the phrase, you know, "this time is different" being the taboo thing to say in the investment sphere. Well, that's because human nature hasn't changed much. I mean, we're still the same species that we were even 1,000, 10,000, 100,000 years ago. So tendencies don't change. Fear and greed cycles do not change. So
Absolutely.
that's kind of where it stems from, right?
Absolutely. Things that just happen a bit quicker these days, but you think of the tulip mania or the South Sea bubble,
You just
lots of
humans,
examples.
people, men reacting to their own, you know, biases, to their own you know, base level fear and greed.
Absolutely. Absolutely.
So the reason why I brought up your history background, and in particular your studies in about the gold standard, is because I kind of wanted to peel back the onion a bit. A lot of people know about the gold standard, the origins of the gold standard, but what about the silver standard? I mean, what most people do not know, however, is that the United States, for example, had a silver standard for since
Sure.
its origin. So what about the silver standard?
Well, I have to admit that I'm much less familiar with US history, and of course in Europe we never had in modern times we didn't have a silver standard. You know, the issue with silver is an interesting metal because of course it is a monetary metal. There's no question about that. It's a monetary metal, and if you look at silver, whether it's over the last 100 years or even over the last 20 years, it tends to move, you know, with gold, with the monetary factors, and it tends to move with gold. It can be more exaggerated. It can have shorter term moves. It can have higher spikes and lower lows, but it tends to move in the same broad direction as gold, which means it still acts very much as a monetary metal. So we know that, but I mean, I think it's just essential to say. On the other hand, of course, silver, sorry, is quite different from gold, and in a couple of fundamental ways. One fundamental way, of course, is the industrial demand, which can be a positive as well as a negative, but the industrial demand really doesn't exist in any meaningful way for gold. And the other thing that's really different about silver from gold, and also compared with how silver was 40 or 50 years ago, is that on the production side, on the supply side, there are no huge stockpiles of silver hanging around in central bank vaults, or indeed anymore in people's attics with grandma's teapots. You know, they all have been, all the ones that were, you know, a lot of those were sold in the 1970s, as you know. So there's no huge stockpiles of silver. The silver supplies are all in the hands of individual investors, and that's quite different from gold. And the other thing on the supply side that's completely different, and different from how it was 40 years ago, is that most silver production is byproduct. Probably as much as 80% of silver supply is byproduct. And the only pure silver mines that are left, there's very few up in you know, Coeur d'Alene area now. There's very few in the Western United States. The only pure silver mines really are in Bolivia, Mexico, and Russia. So 80% of your supply is byproduct. What does that mean? Well, some of that byproduct is byproduct of a gold mine. So, okay, gold and silver move together, et cetera, but a lot of it is byproduct of base metals, whereas a lead mine in Bolivia or a zinc mine in Peru. And the important thing about that is if you have a zinc mine in Peru, where 10% of your production revenue is from silver, you do not make decisions on the mine based on the price of silver. You make decisions based on the price of zinc. Same for the lead mine in Bolivia. And so what that means is that silver supply does not react very well, if at all, to changes in the price of silver. Whereas the gold price will react. Now, it takes time, of course, but if the price of gold, falls to 1,100, 1,000, 1,100, 1,900, then some mines will close, expansions will be put on hold, new projects won't come on. The old saying, the answer to low prices is low prices, because low prices restrict demand. It takes supply. It takes time. That dynamic doesn't exist in the silver market, right? The lead miner doesn't restrict his lead production because the price of silver goes down. And so that's one of the reasons that silver can have in 2014, 15, 16, silver fell percentage-wise a lot more than gold did because of that lack of response. But we're in a different situation now. So the good news is that it can have an exaggerated move on the upside because you don't get a big increase in supply.
And is that why typically in precious metals bull markets, silver begins to outperform gold in these big bull? So yeah. in a gold bull market, you should see silver outperform gold. And in other words, the gold to silver ratio to come down, correct?
Yeah, absolutely. And, the interesting thing is we're already beginning to see that now, which is a bit of a surprise, but it just shows you how depressed silver has been relative to gold for a long time. I mean, if you look at this year, silver is now outperforming gold for the year. And that's a very positive sign of a bull market that has some legs. If silver were lagging, and if the gold and silver stocks were continuing to lag, that would be a negative sign. So it's healthy when you see that.
What stage in this precious metals bull market would you say that we are in? Typically, people can identify three distinct stages, right? The accumulation phase, where only like your hardcore contrarians pile up into things. And then you get your institutional money. That's your second stage, coming in to pile up into things. And then finally, your third stage is when retail comes in and takes this, up to the final leg up. Where would you say we're in this bull market?
Well, that's a really interesting question. And this bull market so far has been really completely different from other bull markets. I mean, when you look at the last 18 months, up until the last couple of months, you've seen gold move steadily, consistently, and quite powerfully, but the gold stocks not move until the last few months, and the silver not move until the last few months. And of course, the macroeconomic environment, if you just took a snapshot, don't look ahead, but just take a snapshot, you've got high interest rates that have come off the most rapid in terms of percentage, the most rapid rate hike in history. You've got high interest rates, you've got a strong dollar, and a reasonably strong economy, and a strong stock market. That's not an environment where gold should do well. So we all know that, but I think it's important, in answer to your question, it's important to really, put that front and foremost. So the reason gold went up over the last 18 months was not because the macroeconomic environment was favorable. It was not because investors were flooding into gold. It was because, number one, central banks were buying gold, as we know, consistently. And number two, Chinese savers, Chinese investors, Chinese savers, starting at the beginning of this year, started pouring into gold. It's only really been the last couple of months since, since the beginning of March, that investors of any type have started to move into gold. And primarily it still is, a few, I'll say relatively few, very large and sophisticated investors, whether it's Middle Eastern, families, Asian families, or, large smart investors in the US, like Michael Burry, from the Big Short, who's moved into gold, and people like Druckenmiller, who's moved into gold, Stanley Druckenmiller, who's moved into gold stocks. But the massive investors are still not in this market. So let's just give a couple of examples of that. If you look at the GLD, which is the largest gold ETF, for the last 3 months, even though gold has dramatically moved up, we are still seeing more days where there are outflows than where there are inflows. If you look at coins, which is a good reflection of the retail market, both in Europe and the US, all the coin dealers I talk to tell me they are continuing to get people calling to sell coins, not to buy. You look at the premiums on coins, you look at the deliveries from the mints, because you don't have hard numbers on coin sales, right? But you can look at the deliveries from the mint for new coins, you can look at the premiums. These are pretty good reflections of the demand for gold coins, and they are just not moving up. And most astonishingly of all, if you look at a GDX, which is the largest fund for gold miners, senior gold miners, again, even now, with the gold stocks having moved up so much, you go back to April the 8th, and there have only been 2 days where Vanguard, the fund sponsor, has reported net inflows. I mean, it's just astonishing. And so what this means is that the massive investors, and I'm coming to your question, it means the massive investors are simply not in this market. And another anecdote, if I may, gold funds. We manage a fund, the Peter Schiff Euro Pacific Gold Fund. Other fund managers I talk to tell me they're getting as many outflows as they're getting inflows, even this year, even with gold doing what it's doing. And in Canada, people tell me they're getting consistent outflows pretty much every day. So what that all tells us is whether it's gold or gold stocks, the retail investor, the traditional institutions are simply not in the market. And so to answer your question, I think we are right at the starting line, to be honest, right at the starting line. If we're getting outflows from the GDX, can you imagine, and the gold stocks are still up 30%, can you imagine what happens when investors start buying gold stocks? So yeah, I think we're right at the beginning. And I'll just say, if I may, from an investment point of view, I think investors have a very, very unusual opportunity right now, which is to buy the biggest and the best gold stocks, when they're still cheap, undervalued on a value basis, they are low on a price basis, and yet gold has moved up. If you go back to 1976, probably before you were born, or 2000 or 2009, the start of all these bull markets, in 2009, as you know, the gold stocks tripled for the next 2 years. 2001, they quintupled for the next 7 years. 1976, they went up about gosh, almost 1,000%. That wasn't the GDX. It didn't exist at that time. That was the Barron's Gold Stock Index, which includes a lot of smaller ones. But you get the point. You have these huge moves when you have a bull market. And if you go back to all of these cases, you find that in the first 2 or 3 months after gold starts, after gold bottoms and moves back up, the gold stocks are already up 50%. It's true in 2009. Within a month, the gold stocks were up 50%. And within 3 months, less than 3 months, they were up 100%. And gold had only gone up like 18 or 20%. This time we have the incredible, well, A, unusual, but B, the incredible opportunity where gold has already moved up and the gold stocks are still lagging. Even though they're up 30% off the bottom, they're still lagging.
So would you say that it would be appropriate to play this market using GDX and GDXJ and SIL, given the fact that they've underperformed up to this point? Or, because I've had people like Rick Rule on kind of explain how, the gold mining space is really dominated by a handful of performers. And then the rest is kind of what's dragging the rest of the market down. Kind of the reason why GDX hasn't really performed as well as it should have. Yeah. But to your point there, when the time comes, maybe that'll shift over, maybe that capital will shift over to these gold mining ETFs. Or is it simply a better strategy to go and individually create your own ETF in the sense that you create your own basket of gold and silver stocks? You still there?
I'm here. I lost you there for a second. Oh. I don't know if it's me or you.
What was the last thing you heard me say?
I heard you say, would it be better to create your own ETF?
Yeah. Like create your own basket of gold and silver stocks instead, that kind of identify the right names to put in there.
No, absolutely. I agree 100% with the premise of your question and with what Rick says. First of all, I say if you're going to buy a fund, for goodness sake, don't buy the GDX, buy the Euro-Pacific Gold Fund, which I manage, or a fund like that, because you've got a manager who's picking stocks. The problem with the gold market industry is an extreme, and when I say gold stocks, we're talking gold and silver stocks, incredibly small market. We can talk about that if you want, but a very, very small market. And as Rick says, or I'm paraphrasing, there's the good, the bad, and the ugly. And if you buy the ETF, you are buying market weight, and you're buying the good, the bad, and the ugly. And, it's just not that difficult to pick a hand, even if you're not an active investor. It's not that difficult to pick, 3 or 4 that are good companies compared with 3 or 4 that are not. So no, I would not use the GDX. Now, there's no question, but when this market gets going, a lot of investors are going to buy the GDX. It's just easier, and a lot of people don't want to follow it, and a lot of people don't know any better. An index is the way to go. But no, I would definitely pick your own stocks. Definitely.
Have you seen this chart that's been circulating around? It tells you the gold and gold mining market cap relative to the total global allocation of wealth. Here, let me pull it up and show you what I'm talking about. And I think this is what you were kind of alluding to earlier as well, meaning that, investors haven't really piled on at all to the gold and gold mining stocks.
No, absolutely. Okay, yeah, I have seen that, but absolutely. And, you look at the whole gold mining space, every gold miner in the world, and including the exploration companies, you're talking about $500 billion, maybe a little bit less. Compare that with the market cap of Microsoft or Apple or NVIDIA. The whole sector is. Do you know Tesla sometimes trades more than $48 million in a day? NVIDIA has $48 billion moves in 10 minutes. So, and we're talking about sometimes, not every 10 minutes, of course, that we're talking about the largest gold mining stock in the world. So it is an incredibly small market. What that means is that when money starts flowing into this sector, as Doug Casey likes to say, it's like putting the Hoover Dam through the garden hose. Because, and of course, you get more supply, companies issue more shares, new companies start up, you know, the cannabis stock decides to become a gold miner again, and all that kind of stuff. So the supply increases, but it doesn't, the good quality companies just don't keep up with the demand. Yeah, I mean, that graph you showed is very interesting, and I would warrant that in North America, it's less than 1% among institutions. You know, when I came into this business, as I say, I started my firm in 1991, and I was writing on investments even before that. But all the way through to about 2014, 15, you could look at any mutual fund out there where there's public information, any fund out there with public information. It could be a US big cap or a global value or an emerging markets or an Asian growth or whatever, any fund. They all had some gold stocks, all of them. That's simply not true today. Other than dedicated gold and resource accounts and a handful of accounts, like, you know, the First Eagle Global Fund or something like that, they have no gold at all in the portfolios. Now, that's going to change when gold starts to move up, right? Even if the portfolio manager himself isn't interested and doesn't buy, when he has his quarterly review with the directors, I can guarantee you one director is going to say, I noticed we don't have any gold stocks. Why is that? And I think we should have a little gold stock. You know, gold's are $3,000. We should own some. And so, yeah, that number's going to go up dramatically.
What about silver? Do you think the same conversation will be had with silver?
The same sort of dynamic, but the problem with silver, as you know, is a much smaller market. We're talking stocks now, right?
Yeah.
It's a much smaller market. And the problem with the silver stocks is there are relatively few, just as, you know, 80% of silver is byproduct silver. There's relatively few pure silver mining companies around. Again, there's some in Mexico, but there's not an awful lot. And if you look at most of the silver miners, they have a majority of their revenue from gold, whether it's Pan American Silver or Fortuna Silver or Heckler Silver. They all get a majority from something other than silver. So I think people, managers in many ways look at those. Yeah. I don't think there's going to be this. I think when the silver price moves up, as it already has, there's a demand for silver stocks. And people go to the standbys like Pan American Silver, like Fortuna Silver, even if they don't really have a majority of their revenue from silver. But those stocks have leverage to silver, no question. Wheaton, if you remember, the royalty company that used to be called Wheaton Silver, and then they decided to change their name to Wheaton Precious Metals to reflect more accurately, you know, the revenue mix. But the irony is that they are probably, other than the pure silver miners, that they have the largest percentage of silver revenue of all of the major companies.
So the oil price typically tends to rise in these commodity super cycles that gold and silver obviously take part in. What does that mean for input costs for the various equities in the mining stocks, however?
No, that's a great question because, again, you go back to the early 2000s bull market, something like from 2004 to 2008, even though the price of gold doubled, the margins stayed the same. That's astonishing, and it's something we really need to think about when we say, well, why aren't the gold stocks moving? Now, where we are right now, of course, is we had a high, if you go back, say, last year and the year before, 2022, 2023, we had a strong oil price, and we had inflation in everything, whether it was the price of arsenic or the price of lumber to construct the workers' camps or whatever it was. You had general inflation, but you also had particularly high prices on steel to build mines and on oil. Where we are right now, if you look at where we are right now, we are in an extremely sweet spot, as they say. You look at the price of oil under $90. Compare that with 2012 when the gold price was last over 2,000. Oil was at $144 a barrel back then, and energy is the largest input cost of running a mine. The second largest input is all of those local costs, which includes labor, which includes buying food for your workers, which includes transportation, everything local. And so a good reflection of those prices is the price of the currency of the country in which you're operating. So for a US mining company with a mine in Australia, it's the Australian dollar, and that affects your US profits, right? It doesn't affect your Australian profits, but it affects your US profits. Well, you look at the Australian dollar, the Canadian dollar, the South African rand, they're all the Chilean peso, big mining jurisdictions. All of those currencies are significantly below where they were in the 2010, 11, 12 period. Australian dollar, Canadian dollar, to give an example, they are both trading at 25, 30% discounts to the US dollar. And a decade ago, they were trading at premiums to the US dollar. Now, so that means right now, we are in a very, very good spot for the mining companies. We saw the huge, and the general inflation, I'm not saying it's gone away, but most of the mining companies have brought those costs under control, well under control in the last, two quarters. They brought them well under control. And so if you looked at the first quarter earnings reports, awful lot of companies were reporting costs lower than expected, lower than guidance, and lower than they have been. The second quarter, and strong margins. So you look at the margins for the first quarter, they're not the highest we've ever had, but if you go back over the last 10 years, they are some of the highest quarterly earnings margins that we've had. This quarter should be even stronger, because when you think back to the first quarter, it was really only in March, towards the end of the quarter, when the price of gold really took off. So the price of gold today is about $200 more than the average price that people were selling for in the first quarter. So, and at the same time, the cost inputs have not moved that much. So this quarter should be another very, very strong, much stronger quarter for cash flow, for the free cash flow for the mining companies. But yeah, you're absolutely right. As the cost inputs change, that will obviously diminish the margins considerably. When will that happen? I don't know. I mean, I suspect the oil price will move up at some point, and the commodity currencies obviously will respond. They respond as the commodity industry sector becomes more active, becomes more, becomes a bigger part of the economy. Then those currencies will move up. But I don't think we're going to see that for several quarters, frankly.
Yeah, I saw this post by Harris Copperman. I don't know, you're familiar with him.
Yeah.
Yeah, so he outlined a post on Twitter the other day, and he was talking about how typically with these mining equities and commodity stocks, you see two big runs. One, initially, like at this accumulation phase where they run insanely well, and then towards the end, towards the retail phase. And then there's no man's land right smack dab in the middle because of these input costs rising up. What do you think of that? Is it truly the case that you think that these equities will truly see their time in the sun at the very beginning when investors start accumulating, taking them up from essentially 0 to 1. You've got astronomical returns there just from going from bad to less bad. And then towards the end, when just the retail crowd just piles on and takes these up to a mania level phase.
Yeah, I know. I think that's largely true because the best margins are likely to be at the beginning of the bull market. And that's why stocks, the big cap stocks, often have these big moves right at the beginning. I mentioned 2009. I may be a little off on this, but I think it was 3 months from the bottom in October, and they had doubled. I mean, that's pretty astonishing.
Yeah.
And then they continue to move up, but on a much lower trajectory. And then, of course, towards the end, you get gold at 2,400, 2,500, 3,000, and everybody and their mother wants to be pouring into gold stocks. And, the big cap stocks look more expensive. And, people just want to find something that hasn't moved, which is the wrong thing to do, of course. But the smaller stocks just start, going crazy at the end of a bull market.
Do you see anywhere else with better asymmetry than the precious metal space at the moment?
No, I don't. The only thing I would look at, well, you asked a specific question about asymmetry. No, I really don't. Precious metals, I think copper is extremely strong on a risk-reward basis. And the reason for that, we all know about the demand from electrification, and that's on top of a traditional demand in houses and infrastructure. A lot of the world, America is a prime example, needs to upgrade their infrastructure. But then, of course, as you say, you've got electrification on top of that. So, the demand for copper is well known. The supply, to me, is the more critical thing because there simply are not that many large, undeveloped copper mines ready to come on stream. And the thing about the copper business is it can take 10 years. It can take 5 to 10 years. Well, it takes more than that from discovery, but even when you've got a deposit, it can take 5 to 10 years before that deposit starts producing. Richard Atkinson, who just stepped down as CEO of Freeport, he was asked a question on a conference call about, the new supply they've got, and they haven't brought on any new mines recently, and, blah, blah, why is that, and so on. But he made an interesting comment, which was, he said, even as shovel-ready projects, we've got permits, we've got deposits, they're shovel-ready. If the board of directors said to go today, he said it would be 5 years before they're producing. And so the significance of that is that you can look ahead 5 years and with an extremely high degree of certainty what the maximum copper production is, right? There's nothing that's going to be producing in 5 years' time but we don't already know about today. There might be some upside surprises. There may be no problems in Chile for 5 years, no earthquakes, no strikes. There may not
That's
be
the best case scenario, right?
Yeah, Panama, there may not be a duplication in some other country of stealing someone's mine, shutting it down. But things could all go right. And yet, even if everything goes right, we still don't have enough copper in 5 years' time to meet the anticipated demand. So that means higher prices. It means, number one, it means demand will come down. And we're already beginning to see that, how a lot of countries are scaling back their net zero demands and goals for electric vehicles. That's already scaling back. We know that. But even if you scale it back, we simply do not have enough copper to meet even a conservative anticipated demand. So I'm very strong on copper. I think the Chinese and Hong Kong stocks are extremely undervalued right now, with a very huge upside potential. The big risk there, of course, is either Taiwan, and they're doing naval exercises right now where Taiwan is completely surrounded by Chinese ships, just an exercise. But Taiwan is a big issue, and of course the other big issue is some real conflict, not necessarily military, but some increased conflict, trade conflict between the US and China. And either one of those two could come at sort of any minute, and it will come suddenly. So I wouldn't overload those stocks, but some of them are just very, very, very undervalued right now.
Yeah, probably not a bad idea to get some form of exposure, something, nothing too extravagant, but just some form of exposure. Totally
right. And China, for real contrarians, some of the real estate stocks might begin to look interesting because China's now talking about stimulus for the real estate sector. And you look at some of the stocks, I'll just mention, well, I don't know if I want to mention it or not, because I don't want people just to buy it because based on what I just say now. It's just an example. Oh, sorry, forgotten the symbol. But there's a stock called Agile, real estate based in Hong Kong, and it's trading at 10% of its net asset value. And the price to earnings is 1 times earnings. It's got cash flow. It's got a reasonable balance sheet. But I mean, some of these stocks are just stupidly cheap. Now, along with that goes risk, of course. And we're not discussing that particular company, so I won't go into all the risk factors. But I'm just saying, there are some very cheap stocks in that area.
Yeah, I totally get it. I mean, I was a holder of a couple Russian oil and gas stocks, and saw that turned out. I mean, they were super cheap, had really good balance sheets, et cetera. But with this kind of stuff, you position size accordingly. You adjust for risk and all the things that could go wrong.
Well, you adjust for macro risk, and then there's two other things. One is with a lot of the Asian stocks, you have companies that are and it's true in Indonesia, Malaysia, as well as it is in China, Hong Kong. You have a company that's controlled, 60 or 70% of the shares will be owned by another company that's controlled by the same family. And so you might have one company that owns the real estate and another company that manages the real estate. And of course, if the one entity, the one family controls both companies, they can adjust the prices as they want. So if they want the revenue to swing to the parent company, then suddenly, all the costs are thrown on to the subsidiary. And as investors, as minority investors, we have no control over that. The second thing, of course, is that with these incredibly low, incredibly high value or apparently high value situations, you can have to wait a long time. They can be value traps because you and I are not the only ones. Excuse me, you and I are not the only ones that see these multiples on our screen. And there are reasons that things are as cheap as they are.
Yeah. Well, hey, Adrian, this has been a fantastic and incredible interview. Super stoked to have you on. Before you sign off, though, give us your closing comments and also your socials. Where can people find you?
Yeah, well, we're not on any social media because the SEC doesn't like social media and the compliance is just stupid. The SEC's, still living in the 18th century or something. I'll probably get an audit next week because of that. But our website is the best place to look is adrianday.com, and we have information on the money management as well as the newsletter, adrianday.com. And the closing comments, gosh, I just think this is an incredible time to really be accumulating the gold and silver stocks. Opportunities like this come along, once every 10 or 15 years. And, we've had 3 big opportunities since 1976. That's a long time ago. And I think we're going to get some very, very strong results next quarter.
Yeah, you've got to make hay while the sun's still out. So very telling. Well, hey guys, if you enjoyed this content, be sure to give us a like, subscribe to the channel if you haven't already, comment down below. Do you agree with Mr. Adrian Day's assessment? Do you still think gold and silver have these legs ahead of them that can take them to astronomical levels? Is this a once-in-a-lifetime opportunity? Let me know in the comments down below. Again, you can support the channel by buying me a coffee. Link to that is down below. Or you can just check out any of the cool affiliate links in the description as well. You get a cool product in return, as well as supporting the channel. So with that said, you guys, I will see you in the next episode. Thank you so much for watching. Bye, y'all.
Thank you.